Hey guys, so it's 2016 and financial projections are back. But before we jump to a conclusion, don't worry about that. We're not talking about predicting the financial performance of a company, revenues and costs to the decimal. That's not what financial projection is all about. It's not about accounting, complicated metrics or unlimited scenarios. No, financial projections in 2016 is all about intuition and business acumen. So, what entrepreneurs are expected today is that they show that they understand, first of all, what is the potential of the business they're running, and secondly, what are the key variables of their business and their business model. So, you want to learn why? This is the topic of today. So to answer the question, first of all, I have to tell you what happened over the past 12 months and why there's been a substantial change, or I would say a fundamental change in the VC investment world. So I don't need you to tell you the statistics, but what you can observe is that any metric of VC activity slowed down from the number of deals being performed from the beginning of the year to the average capital invested to even the valuations, right? Everything slowed down. And this has been something that was triggered last year around this time of the year in 2015 in November, and had a waterfall effect that has been observable by most of you guys, or especially those that try to approach VCs, that perceived a change of perception and a change of decision making into the VC world. So as some reports can testify, and we are including a link in the description of this video, a lot of parameters change as opposed to 2015, but also as opposed to the 5 years previous to 2016, right? So from 2010 onward. This has been considered a very favorable market for raising capital. I would say a bullish market. Now things seems to have changed substantially, and this is why financial projections are coming back. So what changed is that the entry level for Series A's just went higher. So the bar was set much higher in terms of the revenues, in terms of the unit economics they want to see, and in terms of the history of growth that you can prove, right? So as we all know, VC firms want to see business models that can guarantee recurring revenues, be in the form of SaaS model, but it can even be in the form of annual licenses or any other sort of business models that allow you to generate a recurring and predictable revenues. But while over the past 5 years, there's been, I would say, it has been much easier to raise capital even with relatively low recurring revenues, like 10,000 euro per month. Nowadays, to be considered for a Series A, we are talking about minimum 30,000 euro monthly recurring revenues to 50,000 euro monthly recurring revenues. So this basically is more than double than what it used to be. And this is something that shows that VC firms are increasingly focused on revenues as an indicator of momentum rather than user growth or other type of indicators that were used in the past. Another thing that VC firms are increasingly fond of are the unit economics based on your type of business model, but in a line of principle, or as an example, lifetime value of your customer, customer acquisition cost, this type of economics that, regardless of your total accounting, as I explained in another video, can show that you have foreseeable profitability in sight, right? So this means that if you would like trim down, some of the reinvestment costs that you are supporting because you're a startup, you're investing in your growth, then you are substantially a profitable company, a profitable operation, or a profitable process. This is very important nowadays. And the third part that they're looking at is the history of growth, meaning that they want to see that you have been substantially performing and you have been substantially improving on your unit economics and your revenues over the past months before deciding whether they want to invest or not. And just having 50,000 euro in monthly recurring revenues doesn't say much, or doesn't guarantee you that you will receive an investment if you don't also have a track record of growth to back that up. So what you see is that while just 12 to 18 months ago you could raise capital, like an investment of something like in between 8 to 12 times your annualized recurring revenues, nowadays that multiple is down to 2 to 3, maximum 4 x's. This means that while just 12 to 18 months ago you could raise even 1 million, or if not more, 1 million in investment with 10k MRR, nowadays you for the same amount you need at least 30 to, if not 40 or 50, right? So the risk-taking attitude of VC firms has definitely cooled down compared to just, again, 12 months ago. So why this happened? Well, first of all, for those of you that don't know that, you have to imagine that VC firms are institutional investors that invest somebody else's money, right? So they have LPs or limited partners that are most likely mutual funds. In some cases can even be individuals, but I would say more some other type of top-tier investors that have to hold a diversified portfolio of assets, and one of them being high risk and high return, high expected return equity investments like VC to private equity firms. So that these LPs that in the end of the day are responsible for determining their level of happiness with the management of the fund, and B, also to making them in the position to raise again another fund, right? So if they do not return a certain type of return in line with the expectations of their LPs, then the chances that we'll raise another fund are very, very limited, meaning that they are failing at their own business, right? So that said, what happened last November is that the stocks of publicly listed tech companies, and just to mention 3 of them, LinkedIn, Square, and Twitter, started to plummet. Just to put in that way. What happened was that stock market investors started to doubt the growth expectations and therefore the valuation and market capitalization of these tech companies as the results of their quarters that were released, and that had a kind of a domino effect, right? The message that stock market investors gave to for the rest of the market down to say even to angel investors is that they are not buying into the long-term vision of the company anymore. They want to see stronger profitability. They want to see stronger fundamentals in order to pay those valuations. So that was a fundamental shift, and that as a first impact in the valuation of private companies that were, I would say pre-IPO. I'm talking about like top-tier startups, the famous unicorns, if you want to call them, but like not only unicorns. I'm talking about really like big companies. So the message that was given by stock market investors was received by, I would say, first of all, institutional investors like the very famous and big mutual fund Fidelity that owned and probably still owns large stakes in the top-tier tech private companies. Just to mention a few of them, Dropbox, Zenefit, and Cloudera. And the result of that was that Fidelity cut their own or marked down their own estimate of the valuation of these companies in their portfolio back in March 2016, right? So that again gave another shock to the market, saying, okay, valuations that have been given in the past were probably a little bit too high, and right now we want to see stronger fundamentals in order to justify that kind of valuation. So in this context, just to summarize, in this context, VC firms are now increasingly revenues driven. They want to see track record, they want to see unit economics, they want to see revenues, which means that they're also going to look at your revenues potential and your growth potential, right? Meaning that projections are now more important than ever, and that's why it's important for you as an entrepreneur to come prepared at the moment where you're going to deal with investment firms. Because while in the past they could just buy in the vision that you have a big market, that you have growth, etc., nowadays they also want to make like a scenario where they can see that kind of big market and those kind of factors that contribute to their decision making also add up when put in a context of projecting the performance of a company. So what is important for you as an entrepreneur is, first of all, to understand very, very clearly the type of business model you have and the type of variables you can act upon. This means understanding whether you are marketplace, e-commerce, SaaS model, B2B licenses, whatever it is, but just know exactly for your type of business what are the things to keep track of. And more importantly, knowing what are the benchmarks for the market or for similar companies, whatever it is. Knowing the benchmarks for your type of business model is extremely important, because if you are assuming that you're going to be able to charge a price which is twice as high as the price for similar services / products offered by competitors, comparable firms, then all of a sudden your projections become very, very unrealistic. So that's something that you should highly keep in mind. Not only understanding your variables, but also looking at what similar companies are doing. What is also important for you is, whenever you have a track record, keep track of your unit economics and be ready to explain them and to show how you came up with them. Calculating the churn rate could be tricky. Calculating the lifetime value of your customer can be tricky, but as long as you are confident with your calculations and you can explain how you came up with them, then you're going to have a easier time in dealing with investment firms, because they are experts in this field. And finally, what's important is also that you're able to put on paper and in a defensible way the growth trajectory that your company has been experiencing so far. And this means focusing on the variables of your business model and your unit economics, show how these parameters have improved over time. This is extremely important. Once you have understanding of your own business, as well as understanding of the market and the variables and the benchmarks of the market, let's call them as before, then you're not only showing to investors that your proposition has some kind of potential in a context where your growth trajectory is plausible and probable, you're also showing to investors that you know exactly what matters, and during the execution of your plan, you know what to keep track of. And as a side effect or a positive externality of that, you're also providing the investors and the analysts of the investment firm with material that they can readily use to make their own decisions, rather than having them to rely on their own estimates, their own benchmarks to make their decision, because you're not in control of that process. You're in control of what you can do and what you can provide to them. And if they trust you, if they can rely on you for the material, the information they're given, why would they replicate that? They would just try to make sure that what you're saying is correct. They're going to probably run some checks, but then they're going to rely on what you're saying, and then you know exactly on which basis they're going to make a decision, rather than just leaving them doing everything and not knowing why you were rejected, for instance. So for you as an entrepreneur, putting your projections in a perspective, in a context, also makes you understand what is required to get them. If you, for instance, have a focus only on Europe, but you find out that to reach 100 million turnover, you need to expand to the US, that's a variable to keep in mind during your execution, for instance. So just to come back to the initial point, putting your projections in a context allows you to see what is the real potential of your business, what's feasible and what's not, right? Because in everybody's dream, your company is a 100 million turnover worth company, but if you run the math, maybe it's not. So that's a very, very good reality check for you, and it's a reality check the investors are going to do anyway, especially nowadays. And finally, I just wanted to add a remark about maybe like several opinions that you can find online. There are a lot of different ways to evaluate an investment opportunity or to actually make a decision about an investment opportunity. You can come across DCF, APV, internal rate of return, multiple on investing capital, you name it. There are tons of financial models you can apply, and the choice of that relies in most cases to the investor and their what are the incentives or what are the ways that their LPs evaluate their performance. But keep in mind that in all of these cases, everything is still based on projected cash flows and projected exits. So that's why projections are a crucial aspect that maybe you could have avoided 5 years ago or even last year, but now not anymore. Because in a time when VC investment slows down, so in the winter of VC investments, entrepreneurs are increasingly required to be entrepreneurs and to run businesses rather than running fundraising machines, because that's not possible anymore. So with that, I hope you have a better understanding, or I hope I gave you some food for thought, and I'll see you in the next video.